I had sent the notes to you on the dividend policy. So are you all able to access the notes? Are you all able to access the notes on the dividend policy? Yeah, so let us now go through that topic for the dividend policy. We can now go through the topic for the dividend policy. So in that topic on the dividend policy, the introduction is that dividends are a part of the earnings. Dividends are meant to be part of the earnings, which are distributed to the ordinary shareholders for their investment in the company, which are distributed to the ordinary shareholders for their investment in the company. So the company should consider the following factors when paying dividends. The company should consider the following factors when paying dividends. Like now, number one, shareholders' expectations. Number two, restrictions imposed by creditors or debt holders. Number C, availability of the investment opportunities and the growth rate of the firm. Then there is also access to the capital market. There is also profitability and the liquidity of the firm. There will also be the issue to do the tax position of the firm, the industrial norms, inflation rate in the economy, the capital structure decisions. So when it comes to the capital structure decisions, there are some elements there. Then the next one is the legal requirements. So legal requirements, they are said this is subdivided into three categories, i.e. number one, net profit rule. So this states that dividend can only be paid out of the retained earnings from them previous period, not premises. It should be from the previous period, and earnings from the current period only. So that should be previous period and earnings from the current period only. Number two is the capital impairment rule. This prohibits the payment of dividends from the sale of the fixed assets. This is because it will be equivalent to liquidating the company, which is against the going concern accounting concept, Number three is the insolvency rule. So when it comes to insolvency rule, this rule states that the company cannot pay dividends when it is insolvent, i.e. assets are less than the liabilities. Assets are less than the liabilities. N being, so shareholders should not be the ones to decide how much dividend a company should pay because of the following reasons. One of the reasons, number one, is that the shareholders and the company are two separate legal entities. Number two, the shareholders may not be having the technical expertise to determine how much dividends are to be paid. Number three, there are several shareholders in the firm with different expectations. Hence, they are not likely to agree on the account of the dividend per share a company should pay. Number four, there is normally an agency relationship between the shareholders and the management. Therefore, if the shareholders determine the amount of the dividend per share to be paid, it will be the principal doing the work of an agent. So those are the reasons why we don't normally allow the shareholders to determine how much dividend per share to be paid. Then I've given you some notes. Dividend policy and divisions include 4 critical issues. A, when should the firm pay dividends? When should the firm pay dividends? B, how should the firm pay dividends? C, how much dividend per share should the firm pay? Then finally D, why should the firm pay dividends? Those are the questions we shall be answering when it comes to the dividend policy. Those are now the questions we shall be able to answer when it comes to the dividend policy. Then when we continue on the same, they were also able to start with the A. When should the firm pay dividends? When should the firm pay dividends? So under that, it states that a firm can pay dividend twice in the course of the year, i.e. Roman letter 1, interim and the final dividends. Interim and the final dividends. Then C, final dividends alone. So we know what we mean by interim. Interim is paid in between the year, but final is paid at the end of the year. So you have those two categories. So the major question on whether to pay interim and final or final dividend alone will depend on, number one, the liquidity position of the company. Number one is meant to be the liquidity position of the company. Number two, bonus or the scrip issue. Number three, the stock split or reverse split. Number four, the right issue. Number five would be the share repurchase. So that is now how we can be able to assess how should the company or the firm pay dividends. So the forms of paying dividend are basically 5 of them. You can pay in cash, you can pay in terms of the bonus, scrip or reverse split, right issue or share repurchase. When you go to M, when they talk about cash payment, this is the most common form of dividend payment. It will depend on the liquidity position of the company, the company's financial requirements. Those are now the issues we need to check. When you go to the next page, I've also given you bonus or scrip issue. When it comes to the bonus or the scrip issue, it is also known as a dividend reinvestment scheme. It involves giving free shares to the existing shareholders instead of the cash dividend. The shares in this case are given to the existing shareholders in the proportion to their current ownership. That's now they mean by the bonus or scrip issue. They have given you advantages of the bonus issue. Then now when you check down there, the other form of paying dividend, they have talked about the stock split or the reverse split. This is where a block of the shares is broken down into smaller units so that the number of the ordinary shares increase and their respective par value will be able to increase at the stock split factor. The stock split is meant to make the shares of the company more affordable to the low income earners and increase their liquidity in the market. I've given you a small example there, but that's not more relevant to me. Then you go to D, how they can also pay dividend is the share repurchase. This is where the company buys back some of its shares previously issued using the cash that it could have paid out as dividend. The share purchased by the company are also known as the treasury stock. Though this method, the company will reduce the supply of its shares in the stock exchange, and given a constant demand, the market price share will increase, resulting in the capital gain. Hence, in these capital gains, we substitute the dividend income. This method will reduce the company's supply of its shares in the stock exchange. And given a constant demand, the market price will increase, resulting in the capital gain. Hence, in this capital gain, we substitute the dividend income. So there are 5 ways. The other one I've not discussed there, the right issue. The right issue we discussed. We discussed the right issue. So now we go to the dividend policies. We can now check through what they have given you as the dividend policies. When it comes to the dividend policies, basically they say that there are 4 major dividend policies that can be followed by a firm. These are a constant amount of dividend per share. Constant amount of the dividend per share. Under this policy, a company will pay a fixed amount per annum per share, regardless of the fluctuations in the profits. So dividends are increased only after an increase in the earnings appear clearly sustainable and relatively permanent. The following graph can show this policy. So that's now the policy for the constant amount of the dividend per share. Then B, constant payout ratio. Constant payout ratio. When it comes to the constant payout ratio, under this policy, the firm will pay a fixed dividend rate, e.g. 10% of the earnings. The dividend per share will therefore fluctuate as the earnings per share change. This policy can be shown in the following graph. So that's now the graph on how to concern when you pay dividend, constant payout ratio. Then there is also constant dividend per share plus extras. So when it comes to that category, it is that this is the compromise between the two policies discussed above. So those are now the constant amount of the dividend per share and the constant payout ratio. It gives the firm flexibility to increase dividend during the years of high earnings. The extra dividend is given to the shareholders in such a way that they don't perceive it is commitment on the part of the company to continue this extra dividend in the future. This policy can be shown as follows. This policy can be shown as follows. So that's now the information given. There is also the residual dividend policy. There is also the residual dividend policy. So under this policy, dividend is paid out of the earnings left over after investment decisions have been financed. Dividend will only be paid if there are no profitable investment or opportunities available. This policy is consistent with the shareholders with wallet maximization objective. So now let us go through that illustration to see how to deal with those four dividend policies. We can now go through that illustration to see how to deal with that portion of the dividend policy. So the example reads that the management of Biwanda Limited is in the process of evaluating the company's dividend policy. The following information is provided. Number one, the company paid shillings 1.2 million dividends in the last financial year. Number two, the profit after tax in the last financial year was 3.6 million. It was 3.6 million. Then, note number three, the company has not issued any preference share. The company has not issued any preference share. Then the next one is that the earnings growth rate has been consistent at 10% per annum for the last 10 years. Note number five, the expected profit after tax for the current financial year are shillings 4.8 million. For the current financial year are shillings 4.8 million. Then the company anticipates investment opportunities worth shillings 1.4 million in the current financial year. Then the company's optimal capital structure is 60% equity and 40% debt. So required, determine the optimal total dividends for the current financial year. If the company wishes to adopt each of the following independent dividend policy. So the first one, they have said pure residual dividend policy. B, constant payout ratio policy. C, stable, predictable dividend policy. Then D, regular plus extra dividend policy. So we can start off with A, the pure residual policy. So you have seen up there D, when we mentioned about residual dividend policy, where we have said that under that policy, the company, the dividend is paid out of the earnings left after investment decisions have been financed. So let us see how to use now what they have talked about, the pure residual dividend policy. So we start with the one for the pure residual policy. We start the one for pure residual dividend policy. The pure residual dividend policy. Dividend policy. So under that policy, we want to determine the maximum dividend to be paid. We want to determine the maximum dividend to be paid. So to compute the maximum dividend to be paid, we start off with the current earnings. We start off with the current earnings. We start off with the current earnings. So current earnings were given to you. The current earnings were given to you in the note number 5. Expected profit after tax for the current financial year. You can see 4 point what? So it is 4.8 millions. It is meant to be 4.8 millions. So we less investment opportunities. We minus investment opportunities. We minus investment opportunities. So investment opportunities was given to you in the note number 6, where they said that the company anticipate investment opportunities worth shillings 1.4 million in the current financial year. 1.4 millions in the current financial year. But I want you to check the note number 7. Note 7, they have said the company's optimal capital structure is 60% equity and 40% debt. So out of that 1.4 million, 40% must be borrowed. 40% must be borrowed. So the one that will come from the current earnings, which is the same as equity, will be 60%. So you get that, but the capital structure states that 60% of that fund should come from equity. 40% should come from the debt. So investment opportunity, we shall take 60%. You get 60% of the 1.4 million, because the 40% should come from the debt. The 40% should come from the debt. So the 40% should be able to come from the debt. The 40% should come from the debt. So what should be 60% of 1.4 million? 0.84. So we minus 0.84. So the balance is now maximum dividend to pay. That difference will now be able to give you maximum dividends to pay. So that should be able to give you the maximum dividend to pay, which is supposed to be how much? 3 points. Sorry? 3.96 minutes. So that's when you apply the pure residual dividend policy. That's now when you apply the pure residual dividend policy. So we go to Roman letter 2. Roman letter 2, they want to apply constant payout ratio policy. So being they are using the constant payout ratio policy. Constant payout ratio policy. Constant payout ratio policy. Constant payout ratio policy. So when we use that constant payout ratio policy, we need to calculate dividend payout ratio. We need to compute dividend payout ratio. So to get the dividend payout ratio, you get dividends paid. You get dividends paid. Dividends paid. Then you divide by the previous year earnings. The previous year earnings. The previous year earnings. So in the note number 1, they gave you dividend that were paid in the previous financial year. Are you able to see 1.2 millions? So you take 1.2 millions, divide by the previous year earnings. Previous year earnings is in the note number 2. Profit after tax in the last financial year, it was 3.6 millions. It was 3.6 million. So because it has some decimal points, we can use a fraction. We can use it as a fraction. So as a fraction, it will be 1/3. As a fraction, it should be 1/3. Yeah, to know that, it should be 1/3. So you are getting 0.33 recurring. Yeah, so 0.33 recurring, it is the same as 1/3 as a fraction. It is the same as 1/3 as a fraction. So we want now to get the maximum dividend to pay. Maximum dividends to pay. Dividends to pay. So to compute maximum dividends to pay, you simply take the dividend payout ratio. You simply take the dividend payout ratio multiplied by the current earnings. Multiplied by the current earnings. So dividend payout ratio is 1/3. Current earnings were given. The current earnings were given. When you go through the note number 5, the profit after tax in the current financial year was 4.8 million. So that now should be in a position to give you maximum dividends to pay. We should now be able to give you the maximum dividends to pay. So how much does it give you? 1.6 million. So after that, now we go to the Roman letter, part C, stable, predictable dividend policy. Let us now check the one for the stable, predictable dividend policy. So we go to C, a stable, predictable dividend policy. Stable, get the stable, predictable. Stable, predictable. Stable, predictable dividend policy, whereby D1. So D1 is the next dividend to be paid. It will be given by the last dividend that you are paid, then you increase it by the constant percentage. So when we are using stable, predictable dividend policy, to get the dividend to be paid, that will be D1. It will be given by the dividend that was last paid. Then you increase it by the constant growth rate. You increase it by the constant growth rate. So the dividend that you are last paid, remember in the note number 1, it was 1.2 million. Then when you go to the note number 4, the earnings growth rate has been consistent at what percent? 10% per annum for the last 10 years. But when you go to that part, see, they said that stable, predictable dividend policy, the growth rate being equivalent to the earnings growth rate. So you increase it by 10%. G is the growth rate, which is the same as 0.1. So that now should give you the dividends to be paid. We simply take what was paid last year, we increase it with the constant growth rate. We simply take what was paid last year, we increase it by the constant growth rate. So that is when you adopt stable, predictable dividend policy. You simply take what was paid last year, you increase it by the growth rate. Because that has been the trend for the last 10 years. So to know how much to pay next, simply take what was paid last, increase it with the growth rate. So we go to the wrong part D of the question. Part D is about regular plus extra dividend policy. Regular plus extra dividend policy. We now go to so we go to regular plus extra dividend policy. So when it comes to that category, when we are using regular plus extra to get the maximum dividends to be paid, maximum dividends to be paid, it will be equal to regular dividends. We add extra dividends. Add the extra. So we start by computing the extra dividends. We start by calculating the extra dividends. We start off by calculating the extra dividends. So to get the extra dividends, you start off the current earnings. You start off with the current earnings. So current earnings, you remember it was 4.8 million, figure note number 5. It was 4.8 million. 4.8 million. That's now the current earnings. Then now you less investment opportunities. So investment opportunities. It was meant to be, remember the 40% of 1.4, you had already calculated, so it was 60% of 1.4. It was 0.8. So it was 0. So we also less regular dividends. So regular dividends are the same as the one for the stable, predictable dividend policy. Regular dividends are the same as the ones you calculated for the stable, predictable dividend policy. So what are you getting for the stable, predictable dividend policy? 1.4. 2.3. Confirm. When you are taking 1.2 million, we increase it by 10%. Should be around 1.32. 1.1 multiplied by 1.2 million. The stable predictable dividend policy. So you should get at least 1.3. So online, I'm saying the regular dividend are the same as the one for the stable predictable dividend policy. So it is meant to be around 1.32 million. We calculated. So when you subtract those two, we should be able now to get extra dividends. We should come up with the extra dividends. We should come up with the extra dividends. We should come up with the extra dividends. So it is giving us which value? So now to get our maximum dividends. So maximum dividends. So we have said that regular dividend is the same as the one for stable predictable. So it was 1.32 million. Then now you add 2.64 million. So that should be able to give you the maximum dividend to pay when we apply the stable predictable dividend policy. When we apply the stable predictable dividend policy. So we can now pick a question from your past papers. We can now pick a question from your past papers. So this one should be September 2021. We check September 2021, question 2, part A. September 2021, question number 2, part A. September 2021, question number 2, part A. So we check September 2021, question number 2, part A. So you go to page 17. When you check on page 17, you get the question. So the question reads that is question 2, part A. Question 2, part A. The question reads that Maridadi Limited is a firm that operates in the textile industry. Is a firm that operates in the textile industry. The firm's operating profit, that is earnings before interest and tax, over the next 5 years are forecasted as follows. So they gave you the year 2021 up to 2025. That is the earnings before interest and the tax. Remember, operating profit the same as earnings before interest and the tax. Then they proceeded to additional information, not number 1. The firm expects to incur fixed financing cost. So fixed financing cost is the interest. Fixed financing cost is the interest. So they gave you 20 million in the year 2021. Remember, it is supposed to increase by 10%, but that figure should not be 20 million because you see up there the operating profit. Even the maximum is only 80 million. The lowest is 10 million. So we change it to 2 million for it to be reasonable, because you will take earnings before interest and tax, then you less interest. So there is no way interest can be more than operating profit if you want to prepare an income statement. So change that figure to be 2 million instead of 20 million, because when you check before additional information, you can see the operating profit 10, 12, 15, 16, and 18. None of them is more than 18. So which means that 20 should be 2 million. Then the note number 2, the firm anticipate investment to be financed each year are given as follows. So they gave you acceptable project. Those are investment opportunities. Those are meant to be the investment opportunities. Then they were also able to give you the corporate tax rate as 30%. The corporate tax rate as 13%. Then number of ordinary shares issued is 10 million. These are expected to remain constant each year. So now required. Under required, they were saying that they wanted you to prepare dividend per share payable each year, assuming the firm would adopt 40% payout ratio as it is dividend policy. Then Roman letter 2, dividend per share payable each year, assuming the firm will adopt residual dividend policy. So before now we go to any of the two, we start off by preparing the cash flow statement or simply the income statement. We shall be able first to prepare the income statement. So we can first prepare the income statement. So we should first of all prepare the income statement. We need to come up with what is supposed to be the income. We need to come up with the income statement. So there is 2021 up to 2025. So there will be year 1, year 2, year 3, year 4, and also year 5. So I'll be able to put 3 zeros at the top. So we start off with earnings before interest and tax. We start off with earnings before interest and tax. So that one was given to you in the first paragraph, operating profit. So this one is 10,000. Year 2 is 12,000. Year 3 is 15,000. Year 4 is 16,000. Year 5 is 19,000. Then now less interest. Less interest. Minus interest. So for the interest, we were given in the note number 2. I said they had given you 20 million, but I said we adjust. The fixed financing cost is what we refer to as interest. So that figure has to be given as 2 million in the note number 1. So this one is 2 million. But they said this is expected to rise at a constant rate of what percent each year? 10%. So can you increase the 2 million by 10%? Get 1.1 of 2 million. Okay. 2.2. So get one, just take 1.2, sorry, 1.1 multiplied by the 2000. So that be able to do, is it 2.2 millions? Like that. Then also increase this one by 10%. Also take the 1200, so the 2200 multiplied by 1.1. This one is 2420. Also increase that by 10% by multiplying by 1.1. 2662. Also increase that one by 10%. 9. So that now will be able to give us, so that now when you minus, we get the earnings before the tax. When you subtract, we should be coming up with earnings before the tax. We should be getting earnings before the tax. We get now the earnings before the tax. So year one should give you how much? 8. Year two should be which value? Year three? 12. 7. 8. Then year 4. 13, 3. Then the last one should give you which figure? 0, 7. 15, 0, 7, 1.8. Yeah, so now we less the tax. You less the tax. Yes. So the tax is 30%. The corporate tax rate is 30%. So what will be 30% of 8,000? 24. How about 98? 30% of 98? 29.40. Yeah, 3.
37.
37. 774. The one for year 4. 4001.4. The one for year 5. 43. 45. 21.5. 54. So when you subtract, now you get earnings after tax or earnings available. Earnings after the tax or earnings available. So you get earnings after tax or the earnings available. Earnings after tax or simply the earnings available. So year 1, it will give you which figure? So year 2, 68. 16. Year 3. This one for year 2 is correct. 68, 60. Then the one for year 3. 8806. Then the one for year 4.
36.
Then year 5.
7550.
7550.
426.
So that was the statement you are to prepare. So now, after preparing that statement, we want now to answer the Roman letter 1, dividend per share payable each year, assuming the firm adopts 40% payout ratio as it is dividend policy. So we start with the Roman letter 1. So Roman letter 1, we are adopting 40% payout ratio policy. So 40% dividend policy, 40% payout ratio policy. Policy. So 40% payout ratio policy. 40% payout ratio policy. So this one, you simply get the 40%. Year 1, it is 40% of 56. Get the value. For year 2, also get 40% of 6860. Get the value. Also, this one, you get 40% of 8806. You get the value. Also, 40% of 933686. Get the value. Also, the 40%. 40% of 105526. Also, get the value. So they wanted the dividend per share. Once you get those figures, you get now the dividend per share. Get the dividend per share. So year 1, you are getting how much? What was 40% of 5600? 2240. So divide by the number of the ordinary shares. Number of the ordinary shares had been given to you in the note number. In the note number 4. You see the note 4. The number of issued ordinary shares are how many shares? 10 million. So divide by 10 million, which is the same as 10,000, because there are 3 zeros at the top. You do the same for year 2. Take those dividends, divide by the number of the shares are, which are 10 million. You do the same for this, the same for us, the same for that, so that you get the dividend per share. So that we get the dividend per share. So finally, there is that Roman letter 2, the one for residual dividend policy. We can now apply the one for the residual dividend policy. We can now apply Roman letter 2 is the one for the residual dividend policy. So Roman letter 2, residual dividend policy, the residual dividend policy. So for the residual dividend policy, you start with the earnings after tax. So you already have it. Year 1, 66. Year 2, 68, 60. 88, 6. 93, 36.6. 10, 5, 5, 0.26. That's now our earnings after tax. So we less investment opportunities. Less investment opportunities. Minus investment. So investment opportunities was given to you in the note number 2. The firm's acceptable investments to be financed each year are given as follows. So year 1, it is meant to be 5. There is also 5,000. Then 65. Then also 7. So now the balance is the maximum dividend to pay after you are financed all the investment opportunities. So that balance will now be maximum dividend to pay. Maximum dividend. That's now for the pure residual policy. So this one is how much? This is 26. Being given here. Then 3806. Then and finally
50.26.
so that is now the maximum dividend to pay, but the question wanted the dividend per share. The question wanted dividend per share. So dividend per share, we take that dividend each year. So 26 divided by 10,000. Those were the number of the shares. Also, this one 2360. So it's 2836. So that is now when you adopt a pure residual policy. So we go back to the handout. We now go back to the handout. We are now on page 6. We are now on page 6. So when you go to page 6, you are given information that there are several theories which try to look at relevance or irrelevance of the dividend payment. So we shall discuss some of those theories. Number one, dividend irrelevance theory. Number one is dividend irrelevance theory. So dividend irrelevance theory, this theory was proposed by Franco, Modigliani, and Morton Miller. So in 1961, who argued that, so that's why it is known as M and M. So M and M is that part of Modigliani and Miller. That's why it is known as MM. It is Modigliani and Miller. Then they proceeded to say that the value of the farm, so they who argued that the value of the farm is determined by the basic earnings power and the farm's risk, and not by the distribution of the earnings. The value of the farm, therefore, depends on the investment decisions, but not the dividend decision. Their argument was, however, based on the following assumptions. A, no corporate or personal taxes. Number two, no transaction cost associated with the share flotation. Then C, the firm's investment policy is independent of the dividend policy. D, the market is efficient, and therefore investors and the managers have the same set of information regarding the future investment opportunities. So those are the assumptions. There is a question in your past papers. There is a question in your past papers in relation to that. There is a question in your past papers in relation to that. So first, if you go to May 2021, when you go to May 2021, there is a question number 2, part B. May 2021, there is a question number 2, part B, where they were asking to describe 4 factors that will affect the company's dividend policy. Those factors, when you check through the notes, I've given you several factors that determines how to pay dividend. So you look at them. So my concern is not even that part. The one I'm interested in, is a question November, when you go to November 2018, question 1, part A. When you go to November 2018, question number 1, part A, it is on page 40. When you go to page 40, there is a question number 1, part A. So that question 1, part A, they were asking you to examine 4 assumptions of the Modigliani and the Miller dividend irrelevance theory. So those are the assumptions of the dividend irrelevance theory. There are 4 of them. You see the way they are arranged? Yeah, so you are to discuss those assumptions. So when you get time, you read that part. But there is another question. It's also another question on that. There is another question on that element. So this one is April 2022. April 2022. Go to the question number 1, part B. April 2022. There is a question number 1, part B. So that question 1, part B, April 2022, where they say that state 5 arguments against Modigliani and Miller view that dividend policy is irrelevant as a means of affecting the shareholders' wealth. So weaknesses, limitations, argument against are the same as the assumptions. Weaknesses, when they ask you for the weaknesses, limitations, or argument against, that is the same as the assumptions. That will be the same as the assumptions. So they wanted 5 of them, but I've given you 4. So that first one is divided into 2. The first one, you divide it into 2 according to them. So that the no corporate tax is a separate item, no personal tax, to make it a separate item, to make them 5. So that you separate them, no corporate tax as one item, also no personal taxes as another item. So that's why they will make it 5. So arguments and the limitations and the assumptions are the same. So they ask argument against, those are the same as limitations. Even sometimes they're same as disadvantages or weaknesses. They will refer to the same thing. So you have to read through that portion. So that's now the Modigliani and the Miller. I've also given you how to prove it, but proving it, we shall be doing a practical question. Proving it, we shall be required to do a practical question. Then still, when you check, when you go to August 2022, August 2022, there is a question number 3, part D. August 2022, there is a question number 3, part D. That question 3, part D, they were asking you to explain the following dividend theories. Roman letter 1, bird in hand theory. So the bird in hand theory, it is number 2 on page 7. When you check in your notes, after Modigliani and the Miller, in your notes, the next one is the bird in hand theory. Then when you check Roman letter 2 of the same question, clientele effect theory, that is the same as theory number 5 in your notes. It's the same as the theory number 5 in your notes. Then they have also mentioned about information signaling theory. That information signaling theory is your number 4. It is meant to be your number 4. So I'm simply pointing them out so that you get some keen interest, because they ask questions on that part. They normally ask questions on that area. So the same case now, if you go to the sitting of, you can now be able to go to the sitting of. So if you go to May 2019, question 1, part A, May 2019, question number 1, part A. If you go to May 2019, question number 1, part A. May 2019, question 1, part A, they say that explain the following dividend theories. Explain the following dividend theories. Information signaling theory, tax differential theory, bird in hand theory, the agency theory. So you go through them in that manner. You go through them in that manner. So after that, I want you now to check the one for May 2014. There's also a question in the sitting of May 2014. So May 2014, question 3. May 2014, question number 3. My concern is part C. My concern is part C. When you check May 2014, question 3, part C. So that question 3, part C, they were saying that Baraka Limited has a cost of equity of 10%. Currently, the company has those shares. So when you check now the required, using Modigliani and the Miller model, show that payment of dividend does not affect the value of the firm. So I would be using that question to demonstrate the formulas we have seen under Modigliani and the Miller. The formulas we have seen under Modigliani and the Miller. Those formulas are the ones I'm going to use to show that payment or non-payment of dividend does not affect the value for the firm. So time remaining will not allow me to finish the question. So, question another class. Is there another class question so that I meet you people from 10? Online, we meet from 10 because you now have like 3 weeks to remaining. So if I don't hurry up, there will be some topics that may be left out pending. So we meet tomorrow at 10. Ama mko na class ingine kesho? Yeah, so we meet tomorrow at 10. We finish the dividend policy. We shall start another topic for at least 2 hours. So we can stop there for today.